Welcome to Advice from the Deal Room. I'm Ben Record.
Matt Russell.
There's a loan where the lender never asks for your tax returns. Not because it's shady, but because they don't care what you make. They care about one number. Does the property's rent cover the property's payment? That product is on pace for a record year. Investors are pouring into it, and most of the people using it can't tell when it's the wrong tool. Today, we're going to talk about what is a DSCR loan, what it actually is, how it stacks up against a bank loan and a hard money loan, and why demand is exploding right now.
Yeah, so DSCR is debt service coverage ratio. So the lender is looking at how the property, just the property itself, cash flows. And they're not actually looking at the full picture either, which is the interesting part about a DSCR loan. The only thing that they're looking at in this case is going to be the rent payments, the taxes, and insurance. This is very popular for 1-to-4s right now out there in the marketplace. A lot of people, 1-to-4s lets you get higher proceeds compared to even just getting a residential loan on the property. The other benefit, it is in the LLC's name and the entity's name, not your personal name, like what you would have to do on a residential loan. So there's advantages why people are using it in that case. And as you alluded to, Ben, you don't qualify. It's not your qualifications on your personal tax return.
So people that maybe have been writing off a little bit heavier or aren't showing as much income on their tax returns, that's not going to ding them with these type of loans. So Matt, tell me the biggest difference between like a bank loan right now versus a DSCR loan, and what might surprise people.
How quick a DSCR loan happens compared to a bank loan, for one. The documentation requirements are much less. They're asking for the lease. They're asking for a property tax bill. They're asking for your insurance policy on it. They are asking for, obviously, your experience, to show your experience. They're asking for liquidity. Yep, because there is liquidity requirements with this. Driver's license, entity documents, but it's much lighter paper load that you have to provide to the lenders on this request. So that is one thing that's way different than a bank loan, and just the speed. The two things they care about in the appraisal, obviously, is the value and the market rent. So you having way above market rents doesn't really help you out in that world. You know, as long as it's market rents and you're good there, you're within market rents, your property taxes and insurance, they don't care if you have a property manager in place. They don't care about repairs and maintenance. They don't care who's paying utilities. You know, that's probably the flip side that is got some concern out there in the marketplace for me. And they only care about, you can get a 1-to-1 debt service coverage ratio. So you can get a loan as long as it's
barely cash flowing.
Operating Inc. If it's just cash flowing at a 1-to-1, so your payment is $2,000 a month and your net, rent income less taxes and insurance is $2,000 a month. There you go. And they're maxing out it at that. And that's, for me, that can put some people, depends on what your long-term game is. Are you going to be increasing rents? Market rents going to be increasing? Are you self-managing? Are you no repairs and maintenance, no utilities? What's this look like? Are you really going to be taking the shorts? What's the reason for this? Obtaining this type of loan, is the reason. And sometimes it makes sense. If this is just a cash out play because you're getting something else out and you're trying to maximize your portfolio, it makes perfect sense. And you are self-managing, you can manage the expenses yourself and get through any shortfalls in cash flow. So there is a good spot there for people. I've used it for clients who are looking to get just that, to get, maybe they bought it in cash and they want to get their cash back out to go do another property, or they have a lot of equity in the property and they want to go use that equity to buy another property. And this overall builds up their long-term portfolio and their long-term financial plan. We've had people that are in it, it's in their own individual names, and they want to flip it to an LLC. And the only way they would qualify is a DSCR loan because they are trying to acquire more properties with residential loans. So it helps clean up their balance sheet and their credit reports that way as well. So there is some reasons why these loans are exploding, but the main reason they're exploding is the light paperwork needed and the cash flow requirements.
What we've seen recently is bank financing is not anywhere near as cheap as it used to be, of course, but it's not that much cheaper than the DSCR loan options we're getting. And sometimes it's almost the same.
Not even cheaper. Yeah, it's the market rates on those, and you get interest-only products on this. You can get ARM products. You can do a 30-year fixed. You have multiple options on this. But the thing is, the rates, we just pulled up on the other day. It was under 7% with an IO option for the client to maximize their proceeds. And so there is advantages to this from a rate perspective. You're like, well, it's the same rate. Why not go with this? Or it's actually a little bit lower rate. Why not go with this?
Exactly. And that's where a lot of times it really comes down to, why do you need it to qualify at that lower debt service if that's what you're trying to make it work at? Like Matt was saying, is it for a cash out play? You're going to invest that equity at somewhere else, so you're going to earn higher returns than that equity staying where it's at anyway. It would make sense. If you're trying to buy a property that really doesn't cash flow at the price that you're trying to buy it at, and the only way you can get it done is a DSCR loan, that's where we would advise a lot of times negotiate the price or something along those lines, instead of just finding a way to jam it into the hole.
What is the strategy? What are we trying to accomplish? Does this fit into that, or is this going to cause pain 5 years down the road, 3 years down the road for you? Maybe you're under market rent right now, and it's going to go up a few $100s a month, and this is a way for you to maximize right now. Or you have another property that you'd rather take that equity out and earn more money. It actually earns you more money by doing this strategy, right? There is reasons and times and places for this, and it's just best to know that going into it before, eyes wide open. Always, again, that comes back to our advice first is eyes wide open.
We always want to know, why are you doing something, and want to make sure that we know kind of what step 2 and step 3 are, because that's where we can give you the advice on what loan structure best works for you. So we kind of hinted at it. Demand for it is exploding a lot, at least in the last week. I think I've had like 6 or 7 people that were asking specifically for DSCR loans. And I think that's mainly because the rate difference between the two is basically next to nothing now. I mean, they're almost the same rates, and the requirements have always been a little easier. But in the past, I would say DSCR loans were 1.5% higher on average than traditional market rates, correct?
I didn't really look at them before too much. And that's the thing. It's been a very popular item in the last year, and most specifically more in the last 6 months. So it's something that didn't align well for some people. And again, a lot of their clients, I'm looking, they wanted some cash flow, and this didn't provide the cash flow because they're getting a 1-to-1. And do you really need to maximize your proceeds? What's your advantage there? Like, are you just capturing that equity up because it's tax free? What are we trying to do here? There's another game right there. You're like, well, I got a couple $100,000 in there. I'd like to have that in my own bank account. It's going to take me years to get that back, and I don't want to cost of selling it today. I don't want to do that. So maybe I can get the money this way because I want to do some rehab renovations on another property. There's many reasons why you might want to capture that instead of using your own money, or maybe you don't have your own money to use and you're just trying to recapture some equity because the value's increased since you bought it. It's been years, and you bought it pre-COVID, and now the value spiked, rents have gone up, and it's in a good spot to be. So there is some advantages, obviously strong advantages to this.
Some of the numbers that I pulled up when I was doing some research, we're forecasting for non-QM lending, which is non-traditional financing, of around 175 billion for 2026 versus only 108 billion in 2025. So almost double compared to what we were seeing last year. So there's quite the switch in it. And I think with the instability just kind of in our economy and in our world right now, some people are kind of going to some alternative ways of getting things done just because maybe they're behind on taxes or their properties are a little bit more strapped than they used to be. I know that a lot of times property owners are trying to sell properties without the work done to make them worth that value all the time. And so sometimes the ways that people are getting it done is with these DSCR loans. And if the appreciation play works, it works, even if you're not really cash flowing much on the property.
Yeah, because if you go back to the example I mentioned, just numbers on this, you think about, let's say you're collecting $2,500 a month in rent, and let's break this down to easy. Let's just say it's $500 a month for property taxes, $100 a month for insurance. You're at $600 a month. So that means $1,900 payment is what you can qualify. If you're into the banking world, we're going to have to add in you're going to have to add in a few other expenses. Maybe you only qualify maybe the net operating income on that property is now only $1,600, and you get a $1,600, pay, that's your NOI. Your payment's now got to be, we need a 1.25 debt service coverage ratio. So now you're down closer to, if I'm doing the math off the top of my head, like $1,250, $1,300 is all you can qualify for a payment. So you've just went from the one example of you can qualify for $1,900 now payment, and now you only qualify for like $1,300 a month payment. And just so you guys know, disclaimer, these are not exact numbers, just throwing out. That's
This
not
math
quite a
brain at work.
1.25 debts. That's not quite a 1.25 debt service coverage ratio, but taking that into consideration, you're not, that's a huge payment difference. That means a huge loan amount difference, or you might not get the cash out that you were anticipating. If anything, you might have to put more cash into the property to even refinance that out. So that's where the DSCR does come into play, depending on what you're trying to do again. But there's kind of the math difference when you're looking at a commercial loan. Say it's a fourplex, you don't want to go, you're already maxed out, you can't do any more in your personal credit, so you want to go get a commercial loan, and well, you can't do that either because your payment is going to be limited down. So then you're looking at other options, and the DSCR is going to be your next best option out there.
Exactly. And then like even just the client that we looked at, the DSCR loans earlier this year, for me, that she had some properties that she had some equity built up, and she had refinanced them during the great low rates years where she had 3 or 4% rates on some of these. And so they probably had lent a little more money than they would qualify on today's rates. And so refinancing them to get it to work with where her rents were at just didn't work on anything other than DSCR. And it's just a reality of some of the market that we're seeing right now too, where people are on balloons where 5 years, 10 years, they need to look at refinancing. And now they're having to refinance in a much higher market than they did before too.
So yeah, if you have, for some reason, you got on a fourplex, you got a commercial loan, 5 years ago, and now you're coming up, you only got a 5-year balloon, and now you're coming up and you're like, it doesn't cash flow today's market. DSCR might be your way out instead of just selling the property.
At least it gives you a little bit more time to see how the property develops, gives you more time to get rents up, to improve it so that you can take it out to more conventional financing. One of the couple things I wanted to talk about was just like how our structure is different. So we talked about the rates a lot, and we talked about the DSCR, like part of it, but the terms generally pretty much the same, correct? Like 10-year terms most of the time with amortization?
No, they got the 30-year AM, but they got different term options depending on what rate you're choosing. Are you going for an ARM? Are you going for interest only? What's your avenues? They give you a lot of different options for structuring that payment out. And obviously, it comes back into what some of them, it depends on the loan amount you're going to get too. So you play with the different options. So I think the one I sent you the other day, I don't know, there was like 6, 7, 8 options.
Yeah, there was both the 10-year fixed, a 5-year ARM, and then there was both the 10-year IO fixed and the 5-year ARM IO. So interest only options for both of those structures, which I believe the 10-year interest only was the best option for if you're just purely going off of payment. The big reason you would pick something like that is if you're so confident that in 10 years from now, it's going to be worth more than it is now. You don't really need to worry too much about paying down the principal in that time frame. You're going to be able to refinance it. And it allows you to go reinvest that money at current or at better return for you in that meantime than paying down that debt.
It's been asked about more recently from clients. It's definitely been a request on my end too from new clients I've been talking to as they're looking at their 1-4s and looking at, and we continue to address 1-4s. There's other ones out there, but that's the main focus right now because what they're also doing, these are being packaged up and sold into bonds on Wall Street is what they're using these for. These are still underwritten to guidelines to be able to sell these loans out into the secondary market. So that's kind of what's happening behind the scenes. Obviously, there's some desire for some risk out there in the marketplace. Some people need to put their money somewhere. So that's kind of what we're wanting to address this now because it is starting to become a popular item from people requesting and how do they maximize proceeds in today's interest rate environment. And this is one option out there. And it all depends on what your end goal is.
The one other question I had, mainly just one actually a pure question for me. I know that there's DSCR loans for like commercial buildings. Is there good options for like true mixed use commercial / residential on DSCR?
There's options out there for there's so much
That's kind of what I
there's so
figured.
many
So
credit options are out there in the marketplace. It's what are you looking for? And if you really look at DSCR loans, it goes back to large if you think about a CMBS deal, commercial mortgage-backed security deal, and we've done some of those, they are, at the end of the day, a DSCR loan, but the difference is they're not just looking at property tax and insurance. They're looking at the full expenses on it, and it's underwriting it to that. They're not looking at the personal guarantee. There isn't one on it. It's the LLC. They're looking at it from that perspective. So it's similar, but the difference is on the DSCR loans that we're mentioning now, they're looking very light on expenses. And my own personal opinion, I'm curious of how that secondary market blows up in their face down the road.
yeah, especially with, we know that we've seen some people that the only way the deal gets done is with DSCR, but that doesn't necessarily mean the deal should have gotten done in the first place. And setting yourself up for a little bit of a ticking time bomb there if too many of those deals go bad, for sure. We hope you guys enjoyed this. We wanted to kind of just dive in. We're going to do a little bit more of these shorter form ones from time to time where we kind of just answer a question, dive a little bit more into a topic. It's a question that we get a lot, and we want to have more of those that we can kind of share answers with for you guys. Give us a like, follow, subscribe, shoot us a DM, follow our podcast, share it, send it out to your friends so we can get more people listening. And we will be back next week.
All right, guys, have a good week.
Thank you.